Chinese economy grew by 6.2% in Q2 of calendar year 2019, sequentially decelerating from the 6.4% growth in the previous quarter. Now, there is an official expectation for GDP growth in 2019 between 6 to 6.5%, which will in turn be lower than 2018. Let's do a three-point analysis to understand the reason behind the slowdown and what's the way forward. 1. China's GDP growth rate has slipped to a 27-year low. China's industrial growth has moderated while the retail sales are still stable. Retail sales were stable at 8.4% in H1 calendar year 19. However, growth in China's sub-segments such as strategic emerging industries and high-tech manufacturing industry in H1 has been decent. Further, investment in the high-tech manufacturing industry and the high-tech services industry has increased year-on-year in H1 calendar year 19. While higher investment suggests Chinese government's priority areas, it may attract Trump administration's attention in the ongoing trade talks. 2. Worries on external trade persist. While June month data has seen improvement in few sectors, this should not take away attention from the subdued domestic economy, which is further aggravated by US-China trade war. Note that while China's net exports contribute about 3% to GDP, size of China's total trade, that is import plus export, is 33% of GDP. China's exports is down 1.3% and imports have slumped by 7.3% year-on-year in June 2019. Bilateral trade with the USA is impacted significantly. Exports are down by almost 8% and imports are lower by 31% in June 2019. Note that it was the first full month of higher US tariffs on $200 billion of Chinese goods. And US contributes 19% of total exports from China and 8.4% of imports to China. 3. What lies ahead? Well, Chinese markets are assuming that there may not be an early breakthrough, which means more pain for external trade, both in terms of elevated duties as well. China has also stated that economy is in grave situation and global growth has slowed and also external uncertainties are on the rise. US Central Bank has in the meanwhile indicated dovish outlook on the interest rates. Now for India Inc., which is grappling with its own domestic weakening of demand environment, lower commodity cost and lower interest rate regime also comes at a timely reprieve for India. However, we caution that the global and domestic growth revival would take longer than expectations in the second half of 2019, and hence investors should stick to quality companies. Further, improving capacity utilization in China for metals and chemical space along with US-China trade war indicates that in days to come, higher supplies to India can be expected, which can adversely impact the select commodities supply-demand balance.